So we are going to take a look at a case study of someone that we put a policy together for. We put it in force when I first started kind of branching off on my own. So this is nice to kind of see a policy living the test of time. This specific policy was issued in 2014. So it is 6 years old. It'll actually be a full 7 years this August. So his policy anniversary date is coming up this August. So that'll be policy year number 7, which is great. We've seen it perform at a strong level. But to kind of set the stage for this case study, the policy was on a 30-year-old male at the time. So he was 30 years old. He was attracted to the idea of cash value life insurance primarily through the banking concept. He wanted to practice infinite banking. He liked that idea, said, hey, I can pay money into a policy, have access to my cash, my capital, and be able to use it for things like buying a new car, investing in real estate in the future. And then as he learned more, he said, hey, I like the idea just of a cash value life insurance policy in general. I mean, I've got a small 401k at work, but I don't really like putting a whole lot of money in there. The reason being is I'm 30 years old now. I'm going to have to wait just about 30 years to have some real access to it. And I've got to deal with taxes, penalties. Like, I'd rather have access to my money now. This way, if an opportunity pops up, I can use it to the fullest extent, which cash value life insurance provides that. So he also is building savings with it. Then he also wants to save for a house, and this will complement that. So his payments, when he first opened the policy, he could afford or commit to $5,000 per year at the time. That's how much he could actually pay into the policy. Now, his income has increased over the years, so he's got the ability to add more to that existing policy. You know, on that point, he did bring up the idea. He said, hey, Steve, I can open up more policies, right? And the answer is yes, you certainly can open up more policies. However, what I will mention is this policy, we equipped it with a little bit of extra mech space. Remember that mech limit. And you've got a little bit of room from your insurance premium limits as far as how much room the company will allow you to add into PUAs per year. My point being is before we open up a new policy, from a pure monetary standpoint, adding PUAs, dumping money into cash value, will certainly accelerate the growth and your monetary value overall to a much greater degree. The reason why is, remember when you first opened that policy, the first year, that's the worst year. We pay money in, less shows up relative to what we pay in. Every year after the first year is the best year. I get more and more back relative to what I paid in. I'm over the initial insurance expenses. It looks great. So we equipped the policy, and as he received bonuses and pay increases, he added more money into the policy. You're going to see actually in the case study that his ongoing payments are now $7,500 per year. He increased them from what was $5,000 to $7,500. Now, one other quick side note that is interesting, because it's good to observe from case studies to see, hey, what did this individual do? Or what is he actually doing? What value is in learning about one situation so I can then execute the same thing if it benefits my particular situation? So when he first took the policy out, he received a non-smoker rating. Wasn't unhealthy, but had some things. As a result, did not receive a regular preferred or ultra preferred rating, non-smoker. However, we had a discussion. He asked, hey, if I get a bit more healthy, if I start dieting and exercising, can I ever improve my rating, or would I have to get a new policy at that time? And really the conversation was, well, Alex, you know, if we take any life insurance policy, a lot of people aren't aware of this, is you can actually upgrade a health rating on an existing policy. You would be subject to medical underwriting again, so a nurse has to come out, ask medical questions, take blood and urine. They're going to order medical records from your physician, your primary doctor. But if they review everything and they say, hey, he's much healthier now than he was back then, well, they'll upgrade the health rating. And what he actually did was jump from non-smoker, to ultra preferred, which is the top health rating class. And the neat thing is when you looked at the policy, what had actually happened, he did this a couple of years into the policy. They actually went back to the company, when I say they, the insurance company went back to day one and assessed that ultra preferred rating from then. And what was neat is you saw a nice little jump in the cash value compared to what he had the day before and the day after the health rating upgrade was actually assessed, which is pretty cool when you see, hey, it literally pays to be healthy in this case. So he was able to upgrade the health rating on an existing policy as a result. So let's take a look at a case study, because just recently, within the past month actually, he had called up, said, hey, things are going great. I am looking to buy a new car. You know, my car right now, it's lasted me, like 220 some odd thousand miles. He said, it's a great car, but it is time for a new one. I've got my money's worth out of the existing car. I'm like, okay, what kind of car are you getting? Because I like cars. I always ask that question. So the car he was looking at costed about $30,000, thereabout. So here we're going to look at modeling his existing policy, not a new fresh illustration, but his actual policy and what it looks like if he pays money in, lets it sit and grow, compared to loaning it out and then repaying it, and then practicing IBC, where he's going to borrow, repay that loan, and throw in extra PUAs on top of the loan interest. So let's check it out. So here we've got our policy issued in 2014, 30-year-old male. On the left, we've got our growth. So this shows paying in $7,500 per year up until age 50. If he wants to keep going at that point in time, he will, but we're going to stop the payments here at age 50. 20 years of funding. Present cash value, $37,502. So that's at year 6. Remember, when he first opened it, he was paying in $5,000 per year. However, he has paid in more than $30,000 because over the years, as he has received bonuses and such, he's been throwing more money into PUAs, which has accelerated his cash value growth. These values have been larger than 0. This is just his in-force illustration, so we don't have those back values, or I didn't manually input them all. So there's the cash value growth over time, growing by more than what he's paying in each year, which is great. That's exactly what we expect to see with a well-designed policy. But then we're going to look at loans here. So identical policy. All we're going to do here is take a policy loan and then repay it. So he takes out the $30,000 car loan, still making the same $7,500 per year payment. That does not change here. What he does is begin to repay the loan at $500 per month, or $6,000 per year. What I will add as a quick side note is we actually illustrated here deferring the loan for 12 months. So you'll notice no payments in the first policy year. He didn't pay anything. On month 13 is when he started applying those payments. So pay $6,000 per year until the loan is paid off. With his particular policy, the loan interest rate is 5%. Now he does have the option to finance directly through the lender at 0%. Actually, no, not for the car he was looking at because it was used. Point being is that is something we always like to measure to say, hey, do I use my policy directly or does it make sense to finance elsewhere if I can get a better rate and kind of weigh them out from a mathematical standpoint. But what I want to focus on here is when the loan's repaid, when it's repaid. In this example in year 13, for my cash value and death benefit compared to the example when I just let it sit and grow. And what do you notice? The cash value is 100% restored to exactly what it would have been as if I never touched it in the first place. So there's no lost opportunity cost. When I borrowed, so if I look at year 7 here, in the example where I let it sit and grow, my cash value is $45,000. When I borrow out $30,000, your cash value reduces as a result. It's about $14,000. Your cash value is your equity. If you liken it to a line of credit, that's how much money, that's the gauge that determines how much I can actually borrow from the policy. Now, they're still going to pay him dividends on the borrowed money and what's left over in cash. How they do that is, one, they do charge interest on the loan. That goes to the insurance company. And then two, they collateralize the death benefit, dollar for dollar. Anytime you take a loan from a life insurance policy, you will see that occur, a dollar for dollar reduction on the death benefit. Remember, the insurance company's first and foremost obligation is to do what? Pay out life insurance claims. So if we die with a loan outstanding, they're okay with it. We can put it that way. They're on the hook for that much less. Okay, so let's continue on. On the right, we've got the fund policy. So exact same thing from the funding, $7,500 per year, initially in light blue. We take the same $30K loan out. So in year 7, when we do that, death benefit collateralized, cash value reduction, exactly the same as we saw in the last example. Now, the difference here, or I should say the consistency first, is that I pay it back at the exact same pace, or he pays it back. $500 per month, $6K per year, that's how he is applying money toward the loan. Now, what he does in addition to that, he said, hey, if I want to practice the idea of paying myself extra interest, because the loan interest goes to the insurance company, the loan interest stated on the policy. But if I want to pay myself extra interest, that concept, what that entails, well, Alex, it's exactly what you've been doing, in the sense when you've been adding additional funds into PUAs, you can do the same thing here. But now we're just modeling it to be repaid with your payments and loan repayments. So he's paying in $7,500 plus another $1,000 per year. So his net payment, aside from the loan, would technically be $8,500 in these years. He's paying an extra $1,000 in there. So the impact, here's what I'm interested in, is I want to see when my loan is paid back, what's my cash value? 109.14, where I had paid back the loan plus an additional $6,000. So another 6K, I've got 109. If I did not pay the extra 6K in there, what would I have? 102. So close, it's about a 75, a little bit over, or a little bit under a $7,500 gain, where I paid in 6K. So it's a net $1,500 of dividends and interest credited to my policy from paying in that $6,000. And it will compound over time, right? If you look at year 20, here's what we got. 205 compared to the other two guys, 196. So I paid in another $6,000. Now I see about an additional $9,000 in cash value. And granted, we only paid in an extra $1,000 for a couple of years, but at the same time, it has an impact. So when we look at case studies with individuals adding a zero on and practicing the same concept, but just adding a zero or taking one off, if you've watched a lot of our content, you likely know this already, that it's the same thing at the end of the day. It's all ratios as far as the policy design, the loan repayments and such. This particular case study was just nice to see it in action, where he started with a 5K per year payment, gradually added more, and now he's at a point in time where he can actually use it. He said, hey, I want to test it out. I like the idea of borrowing from my policy and paying it back 100% at leisure, where I could finance through the institution, but then I've got to pay it back at their terms. You know what? Let me just attack it how I want to attack it here. And then if I want to pay it off in a lump sum, I'll do that later. But he's got control. That's where he was attracted to this idea. So this was certainly a fun case study. As always, I hope this helps. Reach out with any questions, and we would love to work with you. Have a great day.
Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.